If you want to learn how to invest, it's time to study Buffett.
I don't buy for short-term gain. I buy for long-term.
I'd rather hear about a business from someone who actually works in that industry, who's familiar about it, not just some jamoke on Wall Street. That's a lot of money. $10,000 to $200 million. I'll take that.
That is some white guy energy.
10 minutes into our first episode, we're already pulling up an annual report. I
Right.
love this shit. Welcome back, friends and flankers. I know things look a little bit different here, and we'll get into that in a moment. But today's episode, we're going to talk about what made Buffett such a great investor and how you can take these principles into your own investing. Because over the decades as chairman of Berkshire Hathaway, he has laid out a blueprint, and it's really often understudied by individual investors like you and me. So let's take those lessons and apply them to our own investing. But before we get into all of that, you may notice this looks different than our usual setup. And if you saw our last video, you know that I've been struggling a little bit. And so first, for those who reached out, a genuine thank you. Your comments, your DMs, everything, they really did mean a lot. And second, we've been working really hard to build the Flank platform. And so the YouTube channel has kind of just fallen off. But instead of giving up on it, we decided to bring in a co-host, and that's Elliot.
Hey, everybody.
And as the show continues, you'll get to know him plenty more. Trust me.
I can't wait to talk. You know how talkative I am.
So yeah, I'm getting by with a little bit of help from my friends. Elliot, how about you tell us a little about yourself?
Cool. Thanks, David. Hello, everybody. My name is Elliot. I live here in Wilmington, along with my husband and my dog, Rex. I've been friends with David for almost that entire time, which has been average, I would say. No, it's been great. It's been great. I really admire the work that David has done on the Flank platform. I've heard about it throughout our entire friendship, and I'm really, really glad to be here, and I can't wait to get started and meet everybody.
Oh, that's really nice to hear. Thanks,
Yeah,
Elliot.
you built a great thing, and it's really, really awesome. So I'm super glad to be a part of it.
Could you tell us a little bit more about your experience in investing?
Sure. By trade, I work in software. My entire career has been focused around software. I've worked in various different fields, but the common thread has always been working with people and working with software. I currently work as a product manager at a digital banking platform. I would say as an investor, I'm certainly an amateur. I have a portfolio. I've done investment in the past, but I'm nowhere near the level of knowledge you had. So that's one of the things I'm most excited to do, both via this podcast and also using Flank as well.
And really, that's the market that we're going after. The mission of Flank is to bring intelligent investing into the mainstream.
Yeah.
We're not interested in bringing in finance bros. We're not interested in bringing in professionals from Wall Street. You can get that analysis elsewhere.
If you're not interested in finance bros and Wall Street, I should probably leave them.
Yeah. This is a Tech Bros Only podcast.
Yeah, Tech Bros Only podcast, yeah.
But the idea behind that is I'd rather hear about a business from someone who actually works in that industry, who's familiar about it, not just some jamoke on Wall Street, right? I'd rather hear about a pharmaceutical company from a pharmacist or from a doctor, someone who's prescribing these things, who actually understands, is this business going to grow over the long term because of X, Y, and Z reasons? That's what I'm way more interested in. And speaking of which, speaking of the greatest investor of all time and the qualities that made him such a good investor, let's talk about none other than the GOAT himself. I think this is a great introduction episode because we're talking about the greatest of all time. If we wanted to learn how to play guitar, we'd want to look at, we'd want to study Clapton or Hendrix. If we wanted to learn how to play basketball, we'd study Jordan. If you want to learn how to invest, it's time to study Buffett.
Great. I'm super excited because I've seen the books around your house. I know who Warren Buffett is. I've seen the videos, but I don't think I know the core tenets of his development strategy. Obviously, he's great. Obviously, Charlie Munger is also the unsung hero of Berkshire Hathaway. But Warren Buffett, I know a lot about him, but I don't think I know the important things I need to know. So I'm super excited to dive into this.
One of the things that both makes Buffett awesome, but also makes him hard to understand is that he tells you how he thinks about things. For instance, if you look at, and you can see it in the Flank course, when he talks about valuation, the number one way that he talks about how he values a company is he gives you these aphorisms. He will talk about, he'll say, you look back to Aesop 2,000 years ago, and he said something along the lines of, one in the hand is better than two in the bush. And then Buffett says, that was the initial introduction to valuation. Yeah. But what he, and then he's like, but Aesop, and you can forgive him because it was 2,000 years ago, what he forgot to mention was how far is the bush? What are interest rates? He goes into a whole diatribe of why that actually does make sense from an investing approach. But unless you understand the rest of the background, which requires an intermediate level understanding of Buffett and financial analysis, but that's why we're here. We're here to disentangle that, to bring that into the mainstream.
I think what I know about Buffett is that he's very conservative, but also he's bold when others are fearful. He's not here for the short run. He's not doing day trading, things like that. He's here for the long term. I think for me, that's like just really good basic stuff that I followed, right? When I buy, I don't buy for short term gain. I buy for long term. The holdings that I have now, I've had for years, and I plan to keep them for years. I don't think I've ever actually sold any of my investments, and I don't plan to. And I've even got like kind of more ethereal things like crypto, right? But I've never sold anything. So I'm very much a hold person. I think that aligns pretty well with Buffett's general philosophy, right?
That's exactly Buffett's philosophy. He says his favorite holding period is forever.
Nice.
So
Great.
he would rather. I mean, he bought his last time he bought Coca-Cola stock was in like 1988, and that's actually a perfect lead-in to what I believe is Buffett's number one most underrated trait about him.
Sure.
And that's his patience.
Yeah.
He is the most patient investor you will ever meet, and a great example of that is right now Berkshire Hathaway is sitting on $334 billion in cash and cash equivalents.
Crazy.
Which is absolutely insane. That's like the GDP of Spain.
So when you say cash and cash equivalents, is that not investments? Is that literally just cash in hand that they could spend however they want?
That is a perfect question because I don't know, it's a Dalio quote, but I think Buffett would echo it that cash is trash.
Right, because it sits there, doesn't do anything,
and it loses value over
Right.
time.
Yeah,
There's
right.
that's always been the case. That will always be the case, right? What he does instead when he's waiting to find an investment is he parks it in T-bills. So right now,
Treasury bills. Yeah.
Treasury bills, and right now, and specifically short-term Treasury bills. So how I've mimicked that in my own portfolio is I'm sitting on about $300,000 of T-bills right now because right now valuations are high. The S&P 500 is hitting all-time highs. Nasdaq's hitting all-time highs.
Market's doing great.
Yeah, and that's good. We as Buffett-style investors get more excited when it crashes, right? We're greedy when others are fearful, and fearful when others are greedy.
Right.
And that's the thing about Buffett's patience is that he will just sit there and wait and wait and wait until he uses this metaphor of being a batter during like a Major League Baseball game, and instead of having 3 balls called, he's sitting there and he's got, in the game of investing, you have unlimited balls that can go by.
Sure. Yeah. Right. You don't have to do anything.
No.
Everything will keep happening.
No. I would still pair this under his patience, but he also is impervious to others' opinions. He will sit there and he'll have the whole crowd screaming, "Swing you bum, swing you bum," and he'll just sit there and wait till he gets one right in his what he calls his circle of competence, a business that he can understand.
Sure.
And he just waits for that perfect pitch to come, and then he swings with everything he has.
I love the idea of a circle of competence because sometimes when you're looking at investing or like looking to spend some money on something, right, it can be overwhelming. There's so many different things to invest in. There's so many things, so many options you can do. And I think it's a good thing for people to remember that you can certainly focus on an industry or a type of investment or anything you want and just kind of get really good at doing a few things as opposed to being marginal at doing like a bunch of things. And that's totally fine.
Yeah.
It's great. Like it's great advice and great for somebody who doesn't have all the time in the world to sit around and read about businesses all day.
Absolutely. And that would actually be my recommendation to someone who's starting out investing.
Yeah.
Find either the company you work at or find a competitor.
Yeah, sure.
Which is Buffett's favorite question to
Nice.
he said his favorite question to ask management when he goes and interviews management for a company that he's going to potentially invest in. His favorite question, and he wants to learn more about the industry.
Sure.
His favorite question to ask is, if you were stranded on a desert island for the next 30 years and you could not make any other investment after you leave, which one of your competitors would you invest in and why? And he said that question alone gives him so much information about an industry. And so we can apply that to ourselves, right? We can study one of our if you're a business owner, if you're a business executive, wherever you are, you can look at a business that is in your industry and you can just study the hell out of it. And the insights you'll get out of that will just blow you away.
Yeah. It's also nice because it's kind of a natural thing to do for anybody working in a business. I mean, for me as a product manager, I look at other businesses all the time. It's market research, right?
Yeah.
And so it's a relatively natural thing to do, and it can also help you grow your own wealth by being well-informed for not only like your job potentially, but also your investing job that you do after hours.
Yeah, absolutely.
Cool. So, okay, so Buffett, right? He holds forever, he researches, he's kind of cautious and conservative would be the word. But he's making money somehow. Like, how is he making money then?
Yeah.
What are the main sources of his income?
Well, the primary way we could actually look at that, so 99.999% of his net worth is all in Berkshire Hathaway stock. And that's a good idea he did that intentionally when he ended. So in the 50s, he had something called the Buffett partnership, which was he was investing for other people. It's kind of a pain in the ass because you have to deal with people wanting to take money out and move it in. Yeah, and so when he disbanded the Buffett partnership, at the end of that letter, he had 3 recommendations. And the recommendations were to invest in this old textile mill that he was investing in called Berkshire Hathaway, to roll the money over to Oak Tree Capital, which was managed by Howard Marks, another legendary investor in his own right, or he would return the money. But he took that approach of managing for friends and family into Berkshire Hathaway and how he's managed it for years. And one of the key things that he said about that is, I'm going down in this ship with you guys. If you go down, I'm going down too.
Right.
All of his wealth is parked into Berkshire Hathaway. And so the best way to answer that question, how does Buffett make his money, is to look at the Berkshire Hathaway annual report. 10 minutes into our first episode, we're already pulling up an annual report. I love this shit.
What a thrill.
Yeah. So my favorite way to see how a business makes money, it's actually my favorite section in the annual reports. I think mine disclosures are actually my favorite. That's a weird one in annual reports where there's just a federal requirement to say if you have mine safety.
You've got to make sure you've
got to mine it safe.
Got to make sure you're thinking about the mines.
Got it, yeah.
That's what I always say.
Keep your mind on your money. All right, so in part 1, item 1, again, my favorite part of the annual report, we see exactly how Berkshire Hathaway makes money. It's a holding company owning subsidiaries engaged in numerous diverse business activities.
Okay.
So it's a holding company. Okay. And by the number of companies that he owns, it's insane. It's over 60. But the most important of these are insurance businesses.
Wow, really?
Yeah. So Berkshire Hathaway owns Geico. It owns... I don't know if I believe they still own it, but General Re, which is reinsurance, which is insurance for insurance companies.
Right. For anything you can think of, there's a company that does it, and then there's a company that does it for that company.
Yeah.
It's like, this is nuts.
Yeah. But the 2 big segments of Berkshire Hathaway are their insurance arm, and then also their freight. Well, I guess there's 2. Their freight rail. They own BNSF Railroad.
Oh, okay, sure.
And then their energy sector. They do a lot in terms of utilities. Oh. So the way Berkshire makes money is that they own a bunch of businesses, and all of those businesses roll up to Buffett as the chairman of Berkshire Hathaway. And then what's really cool about Buffett's management style is he doesn't really care about operations. When he buys a company wholly, he buys it because he believes in the management team. He thinks that they're doing a great job. He doesn't want to shake things up too much.
I've noticed that he has a penchant and like an affinity for talking about management. Like, in addition to his investment stuff, I've seen a lot of content and a lot of like just stuff about Warren Buffett talking about managers and management. So it makes sense that he is, kind of sussing that out as well as the company's like bones.
He's the big daddy manager.
Daddy's here.
Yeah. But what he does really, really well is that all the retained earnings from those companies, that they all push it towards Berkshire Hathaway. It all rolls up to headquarters. It all rolls up to Omaha. And he then makes capital allocation decisions. Right. That's his sole function. That's what he says his main role as the chairman of Berkshire Hathaway is.
He owns the company. All the revenue comes to him, and he does with it whatever he wants because, he owns them all. So he could say, thank you for all this money you're making. I'm giving most of it over here.
Yeah, exactly. He'll find a new business. His goal for Berkshire Hathaway, right? Just like the mission of Flink is to tangibly reduce the wealth gap by bringing intelligent investing into the mainstream.
Oh, wow. The way you just slid up right off the tongue. You got that locked in.
The mission of Berkshire Hathaway is to compound at 20% year over year.
Oh, wow.
Cool. That's all he wants to do.
Nice.
And so with that actually leads us right into the second point about what makes Buffett the greatest investor of all time and his best virtues is that he understood compound interest at a very, very young age, and he used it to his advantage. If we look at a compound interest graph, we can look at 50 years of growth, $10,000 is your initial investment, and you compound that at 20%. That's $202 million at the end of those 50 years. So that is just, that's a lot of money. $10,000 to $200 million. Right. I'll take that.
Yeah, sure. Same. I think that's what I have a high yield savings account. I think that's what mine should do.
Yeah,
I think that's it's my understanding.
but it is a big unlock though, because if you're not focused on investing where you're trying to make 10,000% return, you're trying to turn $5 into $5 million overnight, right? Risk and reward are there. With more risk, you do get more reward, but you also have a greater chance of total loss. Right. And so, and that's what Buffett says. Rule number 1 of investing is don't lose money. Do you want to know what rule number 2 is?
Go for it.
Don't forget rule number 1. But now what Buffett did, and this is the genius that he had early on, he attributes all of Berkshire's success to 10 decisions made over a 70-plus year career. Sure. And he said if he was pressed, he could probably narrow it down to 3. But one of the earliest ones that he had was, so when you have an insurance company, you pay your premium every month.
Seemingly every hour.
Yeah. And so what he was able to do, the manager of Geico is a guy named Ajit Jain. He's who I thought was going to be the successor, but he's kind of older. He's in his later 70s. Yeah. But he's very good at underwriting. So he was able to take what's called float. Buffett was able to take float from that underwriting efficiency. He could take that money and then he could further reinvest it into whatever his capital allocation decisions were. So now, if we want to look at that and how we could juice that, right? Let's start using insurance numbers. So let's say, I don't remember what the purchase price of Berkshire Hathaway was, especially on an inflation-adjusted basis. But let's just use a round number of $100,000.
I'm disappointed in your math skills. You can't. I mean, come on, inflation's easy.
Yeah, Elliot. And so, but the real unlock here is if you take $100,000 initial investment and then you can juice it by adding to it, right? You're feeding it as you're compounding. Sure. You're not just letting it sit and grow, but you're injecting more capital into it.
That's why you should always add money to your 401k over the amount, over
Absolutely.
The match. Yeah, that's right.
And but if we just say $1,000 on a monthly contribution basis from $100,000 initial investment. So after 50 years, compounding at 20%, that's $2 billion. If you add in, and we'll just do 1% of that initial investment. So if you're reinvesting that initial float, that just almost doubled your gains from that 1% added per month.
Crazy.
Now you're at $3.2 billion.
And this is why you start investing in your 401k early.
Yes. Right. Yes. Or you live a long time. That's the other thing that Buffett says.
Hey, that's an alternative route.
A good plug for our gym friends out there.
If anybody has the solution to immortality, let us know.
Yeah. That actually leads really well to the third point, and that's his emotional makeup. During one of his first TV appearances, the interviewer asked him, what's the most important thing for an investor to do? And Buffett's response was quite eloquent.
It's a temperamental quality, not an intellectual quality. You don't need tons of IQ in this business. I mean, you have to have enough IQ to get from here to downtown Omaha, but you do not have to be able to play three-dimensional chess or be in the top leagues in terms of bridge playing or something of the sort. You need a stable personality. You need a temperament that neither derives great pleasure from being with the crowd or against the crowd. Because this is not a business where you take polls, it's a business where you think. And Ben Graham would say that you're not right or wrong because 1,000 people agree with you. And you're not right or wrong because 1,000 people disagree with you. You're right because your facts and your reasoning are right.
So from the temperamental quality of that, he's saying that he doesn't really care. He doesn't need to be a contrarian. He doesn't need to just go against the grain. Yeah. But he neither derives great pleasure nor great dissonance from going with or against the crowds. He's independently thinking. And that's another key component of his emotional makeup. It's that he doesn't care if he's going against the grain or if he's going with the grain. Right. He's just thinking, and he loves the game. Right. That's the biggest thing, too. That's another huge thing is just loving the game. He'll sit there at his peak. He would read 500 pages of annual reports every day. Every day, 500 pages. That's he just loves studying businesses.
Well, I was going to say, like, it's very clear that yes, investing is fun and it's what he does, but he's just interested in businesses. He's interested in businesses, how they work, how they make money, and investing is something that he does to be involved with businesses.
Yeah, that's exactly right.
It's true love for business.
Yeah, yeah. And we as individual investors do not need to be that serious. We don't need to do 500 pages of research
maybe just
every day.
400.
Maybe 400, maybe 100. I mean,
Depending on the day.
You know how much I love my annual reports.
I've learned very quickly.
They're not that scary. I promise they are not that scary. The first couple are a little scary, but then you'll learn how to navigate them and you can get through them pretty quick. But the last thing about his emotional makeup is that when he buys a stock, we all think that we're just buying paper, right? Paper tendies, all the words that we're hearing from on the Wall Street Bets group, right? Yeah. That's not what he thinks about. He pretends that he is buying the entire business.
Literally buying ownership and just pretends it's entire ownership.
Yeah, even if I wrote a letter to the CEO of Lululemon when I made an investment last year in Lululemon, and he responded, and it's because I pretended like I was an owner of the business because I was. That when you own equity, you are an owner of the business.
That is some white guy energy. I bought $5 of stock and now I own it. Yeah, it's mine.
True imperialism. Oh God,
that's a whole other episode.
Yeah. And that's why I do think that this type of investing can flow so well to the individual investors like you and me. Because even if you just climb the corporate ladder, most CEOs don't, and Buffett, this is a Buffett quote, this is me paraphrasing Buffett, most CEOs don't know how to invest. They know their business very, very well, but then they're going to be asked to go do some mergers and acquisitions, and they don't know the first thing.
Have no clue how to evaluate the business, have no clue how to learn about the thing and be like, I think we should or should not.
And most importantly, if it's at a good price or not.
Yeah.
Like if they're buying it at a good price.
Right. Is this a good value?
Absolutely.
Speaking of CEOs, that's a great segue to our next topic where we're going to talk about a CEO who's been in the news lately.
Oh, who's that?
The CEO of Hims and Hers Health, Andrew Dudum, recently made headlines for a major sell-off of his stock, something to the tune of $33.4 million. That kind of struck me because I was like, oh, wow, I wonder what's going on there. And I really didn't know what it meant or, what it could indicate. So I wanted to bring that up here and talk through it. So let's talk about it. CEO sells off a bunch of stock. If I'm an investor or looking to invest in Hims and Hers, what does that mean for me? What should I take away? What should I look at to see maybe what that means for me?
Yeah. So when a CEO of a publicly traded company sells stock or buys stock or really does anything, donates it and gives it, anything, they have to fill out something through the SEC called the 13F. And the one that we really care about is when we see an open market buy. And that doesn't mean that it was awarded as part of a contract. That means that he or she is going into their brokerage account and actually just buying it right in the open market. And what that tells to us is presumably no one knows the business better than the CEO.
Yeah.
And secondly, that means that CEO thinks that the stock is undervalued and is a long-term investment. So that is a great signal to us when we see that. Again, when they sell it, it can tell us some things, right? It's definitely a yellow flag, especially this. I mean, this headline we're looking right here from MarketWatch says, sells $33 million after a massive rally.
I mean, because if you look at the stock, it was doing great. Like in July it was great. But when at the day after it started to tank a little bit, and then he sold all that stock, and it continued to tank. It hasn't really recovered since.
So when I do see a CEO selling, the first thing I look at is it part of a pre-planned sale agreement, which is called a 10b5-1 plan. And that just means that the CEO derives a lot of their compensation from their equity. And so they want to actually recognize some income. And that's something that we saw Alex Karp doing recently with Palantir, right? Oh. He's selling stock, and it made headlines, but when you actually dug into it, you saw that it was part of a pre-planned sale.
All legit.
Yeah. Now, if they are just openly dumping the stock, that would start to transition from a yellow to a red flag. That means that the CEO thinks that the business is overvalued.
Well, and also like if others start doing it as well.
Yeah, absolutely. Yeah. I'm not super familiar with the story, but when you see a number like $33 million getting dumped out, that's a large amount of capital.
Yeah.
And so that could push it from a yellow flag to a red flag to me.
And based on the performance of the stock after the sell-off, whether or not it was legitimate and or planned, the reaction was not great from the public, right? And that's another thing that goes into it. The investors in Hims and Hers are investing in a company that has great marketing, that has a product that's super duper personal, right? So for me as an investor, I'm potentially using these products myself, and I want to make sure that the company making them is invested in them as well. If I see someone at the top of the company, the CEO, dump a bunch of stock, I would say that the lion's share of people, although they are investors, are maybe not going to maybe not going to do all this research. They're just going to react and be like, oh my gosh, like what's going on, right? So I think that in addition to the paperwork, in addition to how legit these things can be, one of the considerations is potentially the brand impact or just the emotional impact on your shareholders of such a sell-off, especially because I don't think it was super well communicated, and I don't think it was something where he was like, I still believe in the brand, but I'm doing this, right? So maybe a lesson in communication there, despite whether or not it was planned and or came from a good place.
Yeah, absolutely. And the SEC is pretty strict on what a CEO. There's quiet periods and all that stuff,
sure.
and so we can give benefit of doubt. But at the end of the day, what we are seeing is the CEO open market selling a not small amount of his equity.
Yeah.
And he also has a pre-planned sale agreement. So that that happened in January. The market doesn't normally bat an eye after that.
Right.
But when it's something that's just open market selling, then that does make you want to investigate it further. Yeah. And if we actually look at the stock, we can kind of see why he's doing that, right? The stock's up 200% over the last year.
Yeah, it's been doing great.
Yeah, and and then if we look at it, the PE ratio is 58. So what that means is if the earnings of the company were to remain stagnant, it would take you, as an investor, 58 years for you to be made whole. That's not an insanely high PE ratio, but it is lofty. And you look at some of the problems so just for full context, I started studying HIMSS about a year ago. You can see some of my old analysis right here.
Yeah, I've seen some of the old analyses of it, yeah.
And other flankers have been on it as well. And I got interested in the company because I use their products, right?
That beautiful head of hair
I got, right? Genetics are not in my favor
your beard,
there.
Which is better than mine.
Yeah. And then I saw like shampoo and conditioner branded by them. And I was like, oh wow, this is going to be a great consumer discretionary company.
Right.
They're taking the things that you're embarrassed to talk to your doctor about, found a way to send it direct to consumer.
Yeah.
And oh, by the way, they're doing compounded pharmaceuticals.
Right.
So they're basically making it generic.
I think that Roman came before them, but I think that HIMSS overtook Roman quickly because they ramped up their product offerings, and I think also their marketing is really good too. Roman was pretty strong, but I think HIMSS has overtaken them. I could be wrong though. Don't fact check me.
Yeah, absolutely. But it makes sense after a big run up like that why a CEO would sell. I don't like to see it. That tells me, without really investigating the story, that tells to me that he thinks his stock is overvalued. Sure. And that makes me stay very far away from it as an investor.
Well, and you can also see that it has dropped since then. So absolutely,
yeah,
for sure.
And there's the problems with the compounded semaglutides, right? Like with the GLP-1 drugs, there's this and trying to keep up with the story, it changes every day. Yeah. But basically, they're selling generic Ozempic. They have an agreement with the actual pharmaceutical of Ozempic. Yeah. But that's again changing day by day. So
they have the quote unquote.
Yeah.
Okay, so I guess at the end of the day, we talked a lot about how this can be legit. How this can be legit, how it cannot be legit, how optics factor in as well as financials. The thing I want to know is thumbs up or thumbs down. Do you think this was a good move, a medium move, or a bad move?
Yeah, 2 thumbs down.
Wow, 2 thumbs down.
Yeah, I from like you mentioned, from a communication standpoint, from an optics standpoint, it does not look good. Especially when you see a run up like that, right? Like if you see a run up like that and then you see the CEO sell, it's like, okay, he thinks they've gotten over their skis. So yeah, I have looked at HIMSS. I've done 23% of my research, and I'm staying the heck away from it right now.
All right.
And I could be wrong. I don't know. That's just how I see it.
Time will tell.
Yep.
Yeah.
That's all for today's episode. Thanks so much for watching. This is our first time shooting in this new studio with a co-host. Thanks for bearing with us. Thanks for being patient with us. In our next episode, we're going to be talking about why PE ratio is the most misunderstood metric in investing. I'm sure you'll want to catch it. Should be airing a week after this one airs. Can't wait to see you in the next one. Thanks again for watching.